Hello everyone, my name's John Locke and I'd like to welcome you to the winning trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that the risk in trading options is substantial, so please make sure you're aware of all your risks prior to placing any trades. Also note that we are using hypothetical computer simulated examples and or results in this presentation. They're believed to be as accurately represented as possible. Keep in mind the live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading, performance, success, and wealth coach with lockeinyoursuccess.com. And myself and my team of mentors are here to help you win in the markets and in life as well. And today, I'm going to take you into the realm of high probability options trading. Now, high probability options trading, also known as income trading, is where we utilize option strategies to make money from the passage of time rather than depending solely on price movement in order to make money. Now, this doesn't mean we're going to make money all the time, but it does mean we can often make money whether the market goes up, down, or sideways. The strategy we're going to discuss today is called the X4 version 22. The X4 version 22 is one of the 12 trading strategies that we cover weekly real time in our options trading for income weekly webinars within our Go membership. And this strategy is designed more for choppy bearish markets, similar to what we're in today. So it is somewhat bearish bias, market neutral strategy for the SPX, meaning that if the market's relatively neutral is generally when we do our best. Generally in a downtrending market, normally this strategy tends to fare very well. And then if we're in an uptrending market, we also typically win those trades as well, but there are scenarios there where we may end up taking a loss when things get a little bit extreme in either direction really. But it's a very high probability trade, very great track record. The strategy requires a minimum of $3,500 per trade on the SPX, and the example size that we're going to be showing you today is a $35,000 planned capital example size. This strategy does not have a profit target, but generally if we have a good month, it's usually somewhere between $1,500 and $3,000 for a profit number. It can be substantially higher since we don't have a profit target. We are letting our profits run. And as far as an exit loss trigger or a number at which we're going to leave the trade, that's going to be $2,500, which is 7.1% of our planned capital of $35,000. So let's get into the trade. All right, so this is our analytical software. It's called Optionnet Explorer. The purpose of this software is to help you understand the risk of your position. So if you buy stock, it's pretty simple. You buy, 100 shares of stock. The stock price goes up $1, you make $100. It goes down $1, you lose $100. Here we have a very different type of profile. So what we're showing you here is this is our what we call T+0 line, and we have our asset price across the bottom. So the T+0 line here, it's the curved line. That line tells us or gives us an approximation of what the profit and loss will be in our position as of today at any given price point in the SPX. And as you can see, we can literally have a 300-point move in the SPX and it looks like we gain money to the downside. And we can literally have a 300-point move up and we also gain money to the upside. There are instances where we get drawdowns. This line isn't 100% accurate as to what will actually happen, but it gives us a general idea of what should happen should we get those types of moves in the asset. Now, over time, this T+0 line is going to take the shape of this sharp edge line or triangle line here, which is known as our expiration line, which tells us what the value of this position would be at any given price point at settlement. So here, you can say if we're in this range, at expiration, we don't hold the trade till expiration, but if we're in this range later on, chances are we're going to be profitable, potentially very, very profitable. If we go outside the range, we do what we call adjustments, where we're going to move this strategy around to help us maintain profitability and to be positioned well so that we can make a profit on the position here. So you'll notice this trade is actually negative theta on entry. That does happen from time to time in certain environments. Normally it's positive theta on entry. Eventually you'll see we will be in a positive situation, positive theta situation with the trade, as over time this must at some point match our expiration line here. So this strategy is a strategy that's entered 77 days to expiration, so it's a rather long-term strategy. It's exited when the cycle 2 monthly cycles out is 77 days to expiration. So right now we're in the May 2020 2022 expiration cycle. When our July 2022 expiration monthly cycle comes up, then it's time to exit this trade. So that's going to keep us in here approximately 60 days. That can vary depending on the distance between the expiration cycles, but that's about the time frame we're going to have. And if you look here across, well, first of all, let's go here. Here's the date that we're starting. So this is a back testing software. It allows us to go back in time and analyze our positions. Excellent, excellent software for demonstrations. And across the top here, we have the last asset price of the SPX, which is 43.11. Here we have the different option cycles here where they expire. Down the side here, we have the strike levels. This is our position that we're on. And you'll see that, like I said, the asset price was at 43.11. We enter our short strikes, 17 to 27 points under the money. That puts us at 42.90 for our short strikes. In this case, we're doing an iron butterfly, and we're going to max out at 70-point wings. There are different times at which we use different sized wings in the X4 version 22 program, but in this applied volatility environment, we're using 70-point wings. So we're going to sell the 42.90s. We're going to buy the 43.60s. We're going to sell the 42.90 puts, and we're going to buy the 42.20s. And then we're going to see what the delta is, and we're going to add a call that brings us slightly positive delta. In this case, the call is way down, or way up, I should say. The call is way up here at 48.40, and this happens to be an 8.1 delta call. And that gives us our entry position. Here is the delta of our position, and for those of you who don't know, that's the price movement risk in the position. So if the asset price goes up $1, theoretically the position will gain $1. If it goes down 50 cents, I'm sorry. If it goes down $1, theoretically the position will lose 50 cents. That does change as the price moves, and the rate at which that changes is called your gamma. Your theta is your gain or loss from day to day through time at the current price point that we're at. And again, that theta will change depending on where we are within the tent and so forth, and how close we are to expiration and the implied volatility skew curve shifts. All stuff you don't really need to know at this point. Current profit and loss is here, minus $41. That's from our entry costs. Okay, this position, like most of the positions we show on options trading for income, is a position that we check once a day towards the end of the day, and we decide if we need to make any adjustments. As far as adjustments for this, if we get too far behind the market, we roll back. If we get 10 points over our long strikes to the upside, we roll up. And we also have a delta adjustment to the upside, which is going to be minus 25 inside the tent, minus 15 outside the tent is what we're using. So this is our entry position. For those of you curious, this is the price chart. Now this is a non-subjective position, so it doesn't really matter what the price is doing here. We're just entering it on a certain day. We'll let the trade run out, see how it goes. But you can see we're in a very volatile, choppy, a market that appears to be either running sideways or maybe even downtrending a little bit at this point. So that's what we have. Let's just go from trade to trade here. So it's March 4th, Friday. If we go to the first adjustment, that is going to be on March 17th. So some time went by, and we ended up getting a substantial up move in the asset price. And at this point, we're more than 10 points over our long strike. So if I look at where my long strike is, it's at 43.60. Asset price is 43.94 after this decent size up move today. That triggers what we call an upside adjustment. Now, when we do an upside adjustment, we simply move the position, we sell the position off, and we move it up to what we call entry position, as if we entered the trade again. So here you'll see this, we close this position, and since the asset price is at 43.94, we're going to come in at the 43.70 short strikes, which are right here. We have our 70-point wings, and we're also going to, if needed, move this call. Let me see if we actually moved it here. Yeah, we did. We did make a move with the call. We moved it from 48.40 up into 47.60. Again, that deals with the delta shift in the position. So let's go to the next adjustment. So it's March 17th. And that happens to be the very next day. So we went one day here and bam, we get another 52-point move or so in the asset price. If we look at where we are, we're at 44.64. Our upper long strike is at 44.40. So we're going to close this position. We're going to move this up to 44.40 on this. So we're going to sell the position and go back to entry position at the 44 strike level. And again, if we need to, we will make a move in the call. Let me see what ended up here. Yeah, we moved the call a couple of strikes here just to bring down our delta number a little bit towards neutral. And this is our new position. If we go to our next adjustment, so it's Friday, March 18th, we end up doing nothing for 10 days till March 28th. Again, the asset price continues to climb, and we're all the way up here to 45.65. And that being the case, we're more than 10 points over our upper long strikes, which were at 45.10. We are once again going to roll this higher. So we're going to close the position out. And we're going to move to the asset price of 45.40. So we're moving up basically 100 points. The 45.40, we're doing our 70-point wings. We are doing our delta correction with our call. And this is our new position here. If we continue to go forward here, the very next day, the market rips up another 60 points. This is an insane up move in the SPX. And this is a bearish bias strategy, but you can tell we're doing fairly well. We're not up money, of course, but we're only down $116. And we've had this incredible move up in the SPX, very fast, very aggressive. We are, again, over our 46.10 long strikes by more than 10 points. The asset price is at 46.35. That's going to put our position up to, let's see, 46.10. If I do that, see our shorts at 46.10. We are still going to be utilizing our 70-point wings, and we're going to make a delta correction with the call as needed to bring us to slightly positive delta. Here is what the position looks like after our roll. So let's move forward here. We go from the March 29th to April 11th, which is quite a ways. And let's take a look at what happened here. We had the market here, and if we take a look at our price chart, we had this very, very large aggressive up move, and now the market decides to do what it has been doing, is making a very aggressive down move to the downside. So one of the things, even though we had this down move here, you can see we're doing fairly well with our profit. We're up to 721, despite the fact we're in a neutral strategy and the market's been anything but neutral. But we're doing okay. We're up at $721. If we take a look at our risk profile, we are getting to the point where the downside risk is becoming a problem. And that is defined by a couple of ways, but one of the ways I like to define it here, or a general definition, would be if you see our 2 standard deviation move. If we're, say, under 45 days to expiration and a 2 standard deviation move is outside of our lower long strike, generally, and we're positive delta, generally, that's going to be too far down. In other words, we get too far away from the tent. So that being the case, if you used your imagination and you move this 2 standard deviation mark back to this level here, and you can do it mathematically too, by the way, because you know where the upper point is, and you can say, well, the asset price is down 70 points. You can take this whole shaded area and move it down 70 points in your mind, and you can see whether you're in there. That's one of the things that you could do here. But this is far enough back where we're going to be looking at taking a rollback here. And when we roll this back, we only roll it back to the point where we are well inside our 2 standard deviation mark. Again, you'd have to do the math in your head or picture this where the asset price would be today. But this puts us well inside the 2 standard deviation mark. The theory being that I don't want the market to get so far behind the position that it doesn't really have a chance of getting back into the tent area. But I also don't want to go so far back that if I get any kind of reversal, I'm going to be up in this area, because I don't really want to play the market in this area. I'm not going to make any money in that manner. So what we did here is we rolled this back from 46.10 short strikes to 45.10. We rolled it back 100 points, and this is going to be our new entry position. We generally maintain a little bit of positive delta whenever we do a roll. So let me move forward here to next adjustment. So it's April 11th. We go to April 22, and we sort of run into the same situation. So you can see we had this very big up move. Now we're dealing with a very big down move. And we've been gaining some profits. So, usually, as long as we get a little bit of time that goes by, if we're trending down, normally we're making money. So we're up about 1351 here. And this is what we look like. We have a little bit too much downside risk for the same reason we talked about on the last down adjustment. So what we're going to do is we're going to roll this back. And let's see, we rolled it back to here. And this rollback point is going to change, by the way, depending on how close to expiration we are. And we're going to roll it back to about here. And that's going to give us short strikes of 43.70. We're still running 70-point wings. We'll move our call as needed. Right here we're at 61 delta. We're maintaining relatively neutral, slightly positive delta here. So if we go from here, next adjustment is the 26th. So what ended up happening here is the down speed is really picking up, right? You can see the market had two really hard down days. It kind of paused for a moment, and then it was pushing down again. This time it was 108 points, which is a pretty big move on the SPX. We don't see that all that often. Either way, we're back to the point we're a little too far back on this, so we're going to make a rollback. In this case, we're rolling it back from, let's see, where were we? We were at 43.70, and we're rolling it back to 42.60. And that's pretty common for a rollback on these. Usually when you roll back, it's normally around 100 points. It can be more. There are times when it's like 200 points, and times when it's less, but this is pretty much fairly standard. We're up $992. The speed of the move is going to damage us a little bit, but we're doing okay. We have to watch our exit date. We're now at 24 days to expiration, and how far is July here? July is now 80 days to expiration, so we're exiting this in 3 days, okay? And we want to keep that in mind on whether we want to make any more adjustments or not. If we get too close to expiration or our exit date, we're generally not going to make any roll, for example. We'll just exit the trade. So here we have this position. Let's just go the next 3 days. Here's the 27th. Here we get a little bit of a bounce here. We're up 15.12. And here's the Thursday. We have a 109-point up move, and we're up 2,047, and this is looking pretty nice. And then finally on Friday, let me ignore trades. This is going to be our exit date per guidelines. Friday the 29th, we have getting a 129-point down move, another monster move in the SPX. And at this point, we're up about $1,500, just under $1,500. And would it have been better to exit the day before? Yes. And if I'm trading this subjectively, might I have exited the day before? Yes. But again, this is a non-subjective rule set. We're just kind of following our guidelines here. The market's going to give us what it's going to give us. So here, if we take a look at our price chart, take a look at the price movement here. We pretty much lived through this entire up move, the entire down move back to where we were here. And as you can see here, it looks like it's continuing down. But with this here, we would close this position with a profit of, after commissions, of $1,451 on our $35,000 planned capital. Now, one of the amazing things you'll find out about the trade is we got no ways near $35,000 planned capital in the position, meaning our actual profit is actually much, much higher than what we're showing here. From a percentage standpoint, if you're dealing with actual capital in the trade versus planned capital in the trade. But for now, we are up $1,451.54 in a slightly bearish market neutral strategy in only 56 days in a market that is anything but neutral and had a very severe whipsaw from the market going up a very large amount and then coming back down a very large amount. Absolutely amazing. And that is the X4 version 22, this episode's winning trade. If you like what you see, I encourage you to come on over to lockinyoursuccess.com. That's LOCKE-in-your-success.com or thewinningtrade.com and discover how you too can follow along with this and many other great strategies as they unfold during our weekly Options Trading for Income webinars, where we teach you how to master market neutral strategies through showing you multiple trading strategies by the guidelines through varying market conditions. Also, if you subscribe at thewinningtrade.com, you are also the first to be notified about upcoming winning trade presentations. You get to explore past winning trades, and you get to receive access to free bonus material. Also, while you're there, be sure to check out our free Trading Performance podcast, where you can learn to skyrocket your trading results regardless of the type of trading you do. If you have any questions, comments, or anything else you'd like to see on the next winning trade, we'd love to hear from you. Please comment on the video below, and I'll make sure I answer your questions and comments for you personally. Thank you for joining me, and I look forward to seeing you on the next winning trade.